if you buy a holiday home, make sure that you don't spend more than 183 days in Spain. Otherwise, you might be considered a tax resident of Germany and a tax resident of Spain, because under German internal law, if all your economic interest is still in Germany, they will also consider you a resident. Here, the double tax treaty would come into place. In order to avoid that two countries consider you a tax resident, the double tax treaties have established rules. The double tax treaty, in principle, establishes which country has the right to tax you on income or assets. Today I would like to speak about a very important area, which are the double tax treaties. Double tax treaties have a big impact on a lot of people, and maybe some of them are not even aware of it. Double tax treaties come into place when a person has income interests in more than a country. And as we are based in Spain and have a lot of expats or just holiday owners, for each of them at some point the double tax treaty will become important. I would like to explain a little bit how a double tax treaty works. And I'm going to do it based on the example of the German-Spanish double tax treaty. Also, they are all very similar, and what I'm explaining here, most of it would also be applicable to the double tax treaties of Spain with the UK, France or other countries. The first thing is to establish actually where a person is a resident. If we imagine a German client buying a property in Mallorca, you might think he is still a resident of Germany, he just has a holiday home and that's it. Well, this could be a problem if he spends more than 183 days in Spain. Under the Spanish internal legislation, somebody could be considered a Spanish tax resident if he spends more than 183 days in Spain, his family lives in Spain, or if his vital and economic interests are in Spain. So if you buy a holiday home, make sure that you don't spend more than 183 days in Spain. Otherwise, you might be considered a tax resident of Germany and a tax resident of Spain, because under German internal law, if all your economic interest is still in Germany, they will also consider you a resident. Here, the double tax treaty would come into place. In order to avoid that two countries consider you a tax resident, the double tax treaties have established rules which will decide which of the countries you will be considered a tax resident. The assumption of that you have spent more than 183 days in Spain, or that you are a tax resident because your family lives in Spain, can be interrupted and made null and void if you can present a tax resident certificate from your home country, if this country is a country with which Spain has a double tax treaty. So the double tax treaties are important very often in order to establish where you are a tax resident. Apart from that, once it's clear where you are a tax resident, the double tax treaty in principle establishes which country has the right to tax you on income or assets. So to make some examples, you have a holiday home in Mallorca, you are a German tax resident, but you rent out your holiday home. The double tax treaty clearly says, the Spanish, German one, and almost every double tax treaty in the world, that rental income can be taxed by the country in which the property is situated. So any income arising out of a property in Spain, independently of if you are a tax resident of the UK or Germany, will fall under taxation in Spain. Spain has tightened up the situation regarding the property ownership and rental income via companies, which were used a lot in Spain by foreigners in order to buy properties. With the new double tax treaties, which already exist and have been amended and changed, like the Spain, German or Spain, UK and several others. From now on, the sale of shares of a company who hold more than 50% of the assets as Spanish properties will now be taxable also in Spain. Normally, the sale of movable assets as a principle is only taxed in your country of residency. But this exemption is now being introduced by Spain in all the new double tax treaties or amended double tax treaties they are doing, in order to secure that any property transaction, even if it's done via the sale of shares or the holding of the property through foreign companies, can now be taxed in Spain. Also the sale of the shares of a Spanish company, which might have been set up in order to hold the property, fall with the new double tax treaties under taxation in Spain. This is in principle a break of the principle that movable assets are only taxed in your country of residency. On the other hand, understandable, as every country protects any property income in order that it's due in the country where the property is located. When a foreigner changes his residency from his home country to Spain, the double tax treaty with this country is going to be of the utmost importance. Normally, somebody moving to Spain might still have income in his home country. We are going to speak about the main streams of income and how the double tax treaties treat them. For the typical retired person coming to live in Spain, the double tax treaty will have importance in respect of his pension income, his financial income, his rental income he still might have from properties outside Spain, etc. His pension and rental income, normally under the double tax treaties, will be taxable in Spain if he becomes a resident of Spain. There are some exemptions in most of the double tax treaties, like if your pension is due to a public employment, in which cases the home country will still have the right to tax. If you have financial income, for example dividends, because you still have participations in companies, the double tax treaty normally will grant both countries a taxing right. If we go again with the example of Germany, if you are an individual shareholder of a German company who pays out a dividend, the German government will have the right to apply a 10% withholding tax. Spain, of course, will also tax you on the income, but you will have the right to deduct the 10% withholding tax. So the taxation in principle is splitted. Other financial income like interests are normally only taxable in the country of residency. So there will not be any withholding tax home country if you are generating the interest there. Capital gains. Capital gains on the sale of movable assets normally and in principle will just be taxed in your country of residency. There might exemptions apply, like with the Spanish double tax treaty, if the movable assets sold are shares of companies who mainly hold properties in the other country. But these are exemptions. As general rule, movable assets gains from movable assets will only be taxed in your country of residency. All this, of course, for individuals. If we speak about companies who also can have dual tax residency, it's not only double tax treaties who come into force. In the European Union, we would also have EU directives which would apply, which are hierarchical higher than the double tax treaties. So, for example, the Mother Subsidiary Directive, who says that a dividend paid out by a subsidiary in one EU country to its mother company in another EU country is free of any withholding tax. This will apply even if the double tax treaty between these two countries establish a withholding tax, as the EU directives are ranked higher in the legal system than the double tax treaty. As we're discussing double tax treaties, we cannot forget the importance when a company decides to invest in another country. Tax treaties also become important when a foreign company decides to set up a business and have activities in another country. To continue with our example of Germany and Spain, if a German company decides to start doing business in Spain, to choose the correct structure will also need to be looked at under what the double tax treaty establishes. There are several options in order to start doing a business for a foreign company. It can either set up a permanent establishment or it could set up a subsidiary. The taxation is completely different. I'm not going into entering and explaining also the difference of the legal entities. As a permanent establishment, no independent legal identity, whereby a subsidiary is an independent legal entity. If you work via a permanent establishment, the income or profit of this permanent establishment can only be taxed in the country in which the activity is taking place. So a German company setting up a permanent establishment in Spain will mean that the profit of this permanent establishment can only be taxed in Spain. If this German company decides to set up a subsidiary, which subsidiary would be a Spanish company, of course, subject to Spanish corporate tax. The German tax authorities will then be able to tax, if the internal rules do not avoid it, any dividend received. The EU directive, Mother Subsidiary Directive, will make sure that the dividends are paid out without withholding tax from Spain, but then internal German law would apply to the taxation of their dividends in Germany.